Hey there, Brad Castro from GreatOptionTradingStrategies.com. I don't know why, but there is this line from the song Earthbound by singer-songwriter Rodney Crowell that's always stuck with me. 50 years of living and your worst mistakes forgiven. It's a nice sentiment in general, but the line has always reminded me of option trading, or more specifically, the profound structural advantages option sellers have over Mr. Market. It's what I call heads we win, tails Mr. Market loses. And what I mean by that is that I make excellent high-yield income when I'm right. I almost always still make decent to good or better high-yield income when I'm wrong, and I rarely ever book an actual loss. Sounds too good to be true? Well, in this video, I want to look at some of the so-called bad trades that we've successfully and profitably exited in 2025 inside the Leveraged Investing Club, and you can make up your own mind. For some quick background in case you're not familiar, the Leveraged Investing Club is my private membership option trading site that I launched back in 2012. All memberships are lifetime memberships with no recurring subscription charges beyond the initial one-time investment to join. It's a kick-ass community of friendly and supportive traders of all experience levels and backgrounds. We have a lot of fun, and we also make a lot of money. But this is not where I try to get you to join, because it's actually not that easy to get into the club. I only offer it to readers of my daily option tips and insights newsletter. And even then, readers typically only get one invite to join per calendar year. Of course, that means since I'm not selling and spamming you every day with the newsletter, you're actually getting, as the name says, good, quality, actionable option trading tips and insights while you wait for your invite. More good news, getting the Daily Tips newsletter is much easier than getting into the Leveraged Investing Club. You can simply download any of the free ebooks, guides, or special reports on the Great Option Trading Strategies downloadable library page, and you'll automatically begin receiving the newsletter. Or you can also sign up for the newsletter directly. I put a link to the downloadable library page in the description below, and I pinned a direct link to the Daily Tips sign-up form in the comments section. Okay, with that out of the way, let's explore the power of tails Mr. Market loses and look at the so-called bad trades we closed this year, and for some pretty good returns in most cases. So here's the updated list of trades we've closed year to date inside the Leveraged Investing Club, now that we're about halfway through the year. We typically enter trades with durations that are in the 30 to 45 day range. So you can see the trades that went according to plan, and those with super short holding periods really went according to plan. And those with longer holding periods, say 3 months or more, are those trades that didn't go according to plan and were then put into a trade repair campaign. Now I'm going to skip the Realty Income campaign, the ticker O, as that wasn't one of our regular trades, but something of an experiment that involved potential stock acquisition, and then it morphed into something I started treating like a stock replacement position, where the idea was that I could extract more income from continually rolling that 5750 short put and end up outperforming Realty Income's already high yield dividend. So in that regard, the campaign was a success, but if I'm being honest, it was still kind of a waste of capital and time. Okay, when it comes to the bad trades we've successfully exited so far in 2025, Dell was by far the weakest performer with an 8.62% final annualized ROI over 138 days, or about 4.5 months. But check this out. When we entered this trade, originally at the 110 short put strike price, the stock was trading at $118.02 a share. Now, we were able to work the strike price down a couple of times, from 110 to 105 and then later to 100, and still generate net credits on the rolls, which is what we always want. But Mr. Market moved a lot faster than we were able to, and shares hit an intraday low back in April of $66.25 a share. Yikes. Ugly, ugly, ugly. That means at the lowest point, the stock was 43.87% below our original entry point. And we still walked away with an 8.62% positive annualized ROI over the 138-day holding period. True, the stock did come back, but it didn't come back all the way, as shares were still more than $4 lower at the end of the campaign than when we first entered the trade. But this is important. We never needed Dell to rebound 100% and get back to those initial levels. Since we had already worked the strike price down to 100, it wasn't necessary for the stock to rebound back to the original 110 strike price. Anything at or above $100 a share at expiration, and we still would have been out of the trade with the same returns. But what if Dell was only back at, say, $98 a share at expiration? That would work too, because now we would be focusing on working the strike price down once again, this time from 100 to 95, as long as we could do so for a net credit and as long as we didn't have to go out more than 3 monthly expiration cycles. And if that wasn't possible, we would be okay with that too, because then we just roll straight out at the same 100 strike and collect a much bigger net credit on the move and start boosting the overall annualized rate on the campaign. Again, heads we win, tails Mr. Market loses. It's not BS, it's real. Okay, let's look at trade number 2 on Signet Jewelers. And this was one we actually closed out last week. Kind of similar situation to Dell, where I was totally wrong about the downside being limited and the stock really sold off after we entered the trade. The stock was trading at $86.06 a share when we initiated the position with a short put trade at the $80 strike, where I erroneously thought there was a good amount of technical support. Not even close. On an intraday low, Signet hit $45.55 a share back in March, or 47.07% below our entry price. We approached this trade the same way we did with Dell and managed to work the strike price down from 80 to 75 and for a modest net credit. But then the bottom really fell out of the stock and we did a bit of a deviation. We basically held still and allowed ourselves to be assigned the shares early so we could begin repairing the trade from the covered call side of things and at least start collecting the dividend in the process. But we actually held off a bit before writing the $75 call and simply held the shares. That's because at the point we were assigned, I felt the stock was pretty oversold and poised for a bounce, which we did eventually get, so that when we did re-enter the fray, again at the same $75 strike price we were assigned at, we got better terms for the covered call, and even better on our next and final roll as the stock continued to rebound. Final returns, very respectable, 12.41% annualized over 186 days, which I was thrilled with. I sell puts on a stock that drops 47.07% on me, and I somehow walk away with double-digit annualized positive returns. What kind of voodoo is this? Again, the stock did rebound nicely for us, but as with Dell, because we worked the strike price lower, we never needed it to come back all the way. And at the point of exit, shares were still about 5% below where they were when we first entered the trade. Also, we did get one round of quarterly dividends, and that was a nice little bonus for our final annualized ROI. Okay, trade number 3, Celsius Holdings. This one was another wild ride. The stock had already come down a ton from its 2024 highs in the mid to upper 90s, and I thought the bottom was in when we sold puts inside the Leveraged Investing Club at the $35 strike. And I was very much mistaken. In fact, the stock had a lot more downside, and yet we still walked away with terrific returns. We sold $35 puts when the stock was at $41.23 a share, and eventually worked the strike price down to $32.50, even as Celsius traded all the way down on an intraday basis to $21.10 a share back on February 12th, which was a 48.82% smackdown based on the original entry price. Our final returns? 17.04% annualized over 248 days. Now, really let that sink in. 17.04% annualized over 248 days. That's about 8.5 months. Terrible trade. Couldn't have been more wrong. The stock drops nearly 50%, and we walk away with those kind of returns locked in over a nice extended period like that. Kind of the definition of a structurally advantaged strategy, wouldn't you say? All right, fourth and final trade, and I saved the funnest one for last. This one was the quickest of the 4 trade repairs, and it also generated the highest annualized returns, but I do want to address it because there are a couple of important insights. So with ELF trading at $75.03 a share back near the end of February, we sold $65 puts, and you guessed it, I was totally wrong. But this time, on an intraday basis, the stock only went down 34.16%. Our final returns? A really sweet 19.43% annualized ROI over 85 days. Again, to be totally wrong on a put selling trade and still walk away with nearly 20% annualized returns over the holding period, kind of hard not to be an option selling believer when you keep seeing results like this. But let's look under the hood real quick because there are a couple of things I want to point out. First, unlike the other 3 trades that we looked at today, this time after selling off, the underlying stock did in fact come back all the way, and then some. When we entered the trade, ELF was trading at $75.03 a share. And when we exited 85 days later, after a brief period trading around $50 a share, the stock rebounded strongly and was at $81.04 a share when I exited it. So even if we'd done nothing, Mr. Market basically would have repaired this one himself, with no help from us required. Now, while that is true, it does mask something very profound about what we were able to accomplish with this campaign. As with the other trades we looked at today, we also worked the strike price lower on the ELF trade. But with ELF, in addition to that, we got really nice net credits along the way. From the $65 strike to $60 to $55 is a 15.38% total strike price reduction. But while we were doing that, the net premium we collected on these rolls down and out translated to 12.51% annualized on the first roll and 14.66% annualized on the second and final roll. That's the advantage of selling options with higher implied volatility levels. While you definitely want to be working with stocks and options of stable, profitable underlying businesses, elevated premium levels make trade repair much easier. And what if ELF hadn't rebounded as strongly as it did? Remember, we began at the $65 strike price and worked the position down to the $55 strike. So to be out of the trade with our full profits, we didn't need the stock to retake that $65 level. Anything at or above $55 a share at that June expiration, and we still would have been out of the trade with our full profits. So that means, based on the trade's original entry, when the underlying stock was trading at $75.03 a share, ELF could have ended at the June expiration $20.03 a share lower, i.e. $55 a share, or 26.70% lower, and we would have been just fine. We still would have walked away with nearly 20% annualized positive returns. Okay, to wrap up, it's true that the underlying stocks here did come back, but on 3 of these trades, only to a degree, so that when we exited, those underlying stocks were still trading lower than they were when we first entered the trades. And we also didn't need any of them to come back all the way for us to completely repair the trades and be out of them with our full gains. Do you understand how powerful this is? It's not just that we consistently make money when we're right and when we're wrong on our put selling and covered call trades. It's that we pretty much take losses off the table. By all rights, we should have booked big losses on all of these trades. We basically bet Mr. Market the stocks wouldn't trade lower, and then they all cratered to the tune of 35 to 50%. But not only did we avoid losses, we still made good to very good returns. Do you know what a fantastic feeling that is? To have the confidence that if a trade moves against you, not only is it not the end of the world, but that at the end of the day, it's very likely that you're still going to walk away with more money than you started with. Lastly, just wanted to state for the record, in case I may have given you the wrong impression, not every stock I sell puts on crashes and burns shortly after. I actually have a pretty good record of identifying winning, no-drama trades, or as I call them, limited downside situations, where I feel it's unlikely that a stock will trade lower or lower by much in the near term. Those are ideal put-selling setups. And of course, the returns on the trades that do go according to plan are typically much better than those that have to be repaired. I spell out my selection and setup process in greater detail in my complete guide to selling puts on the Great Option Trading Strategies website. It's completely free if you want to check it out, no opt-in required, and I put a link to that in the description below. Okay, if you enjoyed this and want more, be sure to check out the channel's other videos. I recently took about a 7-year hiatus from YouTube, but I'm back now and producing 5 to 10 new videos per month. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are seriously like having a superpower, and I can show you how I develop mine, and I can help you develop yours. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. Okay, until next time.